A very good afternoon to our dearest lecturer of investment law, Madam Farah and fellow classmates. Today we are going to present our pamphlet with the topic of providing the insider trading, what constitutes insider trading. Before we start our presentation today, let me introduce our team members. The team members consist of me, which is Liu Chen Chen, Liu Ikiet, Kevin Khan, Mackenzie, and Muhammad Sazwan. Now I would like to start the presentation with the introduction. It is a news reported where in 2024, insider engagement increased across various sectors and organizations with a clamor trend observed in major tech stocks. However, Amazon and Meta experienced significant insider selling, with Jeff Bezos and Mark Zuckerberg liquidating significant shares. This led to a speculation about a potential decline in the share's value. However, scholars caution that extensive insider selling does not necessarily indicate immediate negative results. In addition, Zuckerberg's decision to sell Meta Platforms shares was likely for charitable purposes, while Bezos' Amazon shares were intended for real estate acquisitions. The limited growth in initial public offerings, which is IPOs, also contributed to the rise in insider activity.
Hello everyone, before we go in deep into what is insider trading, let me briefly tell you about insider trading. So according to CMSA section 188, insider is someone who knows important information of a company that could make its stock price go up or down. And they know that not everyone else knows this information. In the context of publicly traded companies, insider refers to individuals in significant positions like directors, senior officers, and entities that own over 10% of a company voting shares. It also encompasses those who trade company shares based on undisclosed material information. And according to US Security and Exchange Commission, the inappropriate purchase or sales of stocks based on significant confidential knowledge in violations of fiduciary obligations or trust relationships is also known as illegal insider trading.
So next is what constitutes insider trading. An insider should not whether as in principal or agent in respect of any security to which information in subsection 1 relates. Acquire or dispose of security. It is forbidden for an insider to purchase or sell stock to which they have access to confidential information. This covers any direct or indirect activity taken to purchase or sell such security. Enter into an agreement. This includes concluding contract for the purchase or sale of security that are based on insider knowledge. Insider trading is defined as reaching an agreement with the goal of trading on insider information, even if the transaction has not happened yet. Procure directly or indirectly an acquisition or disposal of, or the entering into an agreement for or with a view to the acquisition or disposal of such security. The insider is not only forbidden from carrying out this transaction directly, but they also forbidden from persuading others to carry out this transaction on their own or on behalf of others. This implies that an insider cannot use insider information to influence directly or indirectly someone else to purchase or sell shares. So the next is ethical issue. What makes insider trading a problem? Insider that possess knowledge about a firm that could influence the market price of its issuer share have been linked to unethical trading behavior, which is known as insider trading. While some people think it ought to be legal, others are in favor of law that forbid it. And what are the insider trading criticism? Some claim it is unethical, causing unfair pricing and trading practices. Some argue that it should not be a problem because if it were allowed, price would appropriately reflect the information. Does insider trading pose a serious risk? It is depending on who you speak with. There are those who think it is an issue and those who do not. And the next is the bottom line. There are supporter and detractor of insider trading. Insider trading is opposed by some who feel that is unfair benefit those who possess confidential knowledge. Insider trading proponent contend that it is reduce risks and improve market efficiency. Insider trading is prohibited and can result in penalties and jail time, regardless of one's political beliefs. And the next is related case. Section 188 of the Capital Market and Service Act 2007 charged 3% with insider trading offenses, according to a new Straits Times article from March 30, 2017. Issues: Yu Lei Peng illegally provided non-public information to Lim Boon Hua between December 10 and December 31st, 2007, who both being senior manager at CIMB Investment Bank Berhad. Lim Boon Cheng was accused of purchasing 145,000 shares of Pacific Mass Berhad while processing undisclosed information between December 18 and December 31st, 2007, and held the insider trading allegation with linked to proposed takeover offers by OSPL Holdings, Sdn Berhad for Pacific Mass share. Penalties include a minimum 1 million fine and a maximum 10-year prison sentence.
Now, we'll discuss the crucial aspects of financial markets, the prohibitions of insider trading under the Capital Market and Services Act 2007, specifically Section 188, Subsection 3, Paragraphs A and B. Section 188, Subsection 3, Paragraphs A prohibits an insider from procuring another persons to acquire or dispose of securities based on insider information. This prevents insiders from using their access to non-public information to influence other trading activities, ensuring markets integrity. Meanwhile, Section 188, Subsection 3, Paragraphs B makes it illegal for an insider to communicate insider information if it's likely that the recipient will trade based on the information. This aims to prevent tipping and maintain fair trading practices. Now, let's take a look at factors contributing to insider trading. Financial incentives are a strong motivator. Insiders may seek to profit from exclusive knowledge by trading securities before the information becomes public, driven by the desire to maximize personal wealth or offset financial losses. Secondly, weak regulatory oversight can also contribute. Insider trading is more likely in environments with lax monitoring and enforcement. Without strict penalties, this risk of getting caught is perceived as low, encouraging illegal activities. Thirdly, corporate culture plays a significant role. A corporate climate that condones unethical practices can foster insider trading. Companies not emphasizing compliance and unethical standards may unintentionally encourage exploitation of insider status. And lastly is volatile market conditions. During significant market fluctuations, insider information's value increases, providing opportunities for insiders to capitalize on their knowledge of impending movement. In conclusions, the prohibitions under Section 188, Subsection 3, Paragraphs A and B of the CMSA 2007 are crucial for fair trading. Understanding these factors helps appreciate the needs for stringent regulations and ethical corporate cultures.
Hi everyone, my name is Mackenzie and I am Aronika with the matrix number 79937. For today, I will be talking about the sanctions of committing the offense. According to Section 188, Subsection 4 of the CMSA, it mandates that individuals convicted of insider trading can face up to 10 years in prison and must pay a minimum fine of 1 million ringgit. Additionally, they may be required to pay 3 times the amount of the gain made or loss avoided due to their illegal actions. These sections are intended to deter insider trading, punish offenders appropriately, and maintain the integrity of the financial markets. Let's get into the suggestions to settle insider trading. So, there are 4 measures that will be discussed in our pamphlet. So, the first measure that will be discussed is the regulatory measure, in which Securities Commission should play their role by strengthening regulations and enforcement. They should ensure that laws and regulations governing insider trading are comprehensive and up-to-date. This includes clear definitions of insider trading, prohibited activities, and applicable penalties. The second measure will be the organizational measure, in which the organization should implement robust corporate governance in their company. So, this measure basically means that organizations should develop and enforce a strict code of conduct for employees and executives that include clear policies on the handling of non-public material information. The third one will be the individual measure, in which the firm has to ensure that the senior management and board members lead by example, demonstrating a commitment to ethical behavior and compliance with insider trading regulations. The last measure will be the collaborative measure. Since insider trading can have international implications, regulators should collaborate with their counterparts in other jurisdictions to share information and coordinate enforcement actions.
To conclude, insider trading is like stealing candy from baby investor. It is unfair and hurts everyone playing by the rules. Examples of greedy executives show how bad it can get, but there is still more to be done. Loopholes with watchdogs and companies that do not care much create a breeding ground for cheaters. To make things fair, the market needs stronger rules, honest leaders in companies, and countries working together. Advanced new tech can also help to catch these insider traders. By working together, we can keep the stock market a level playing field for everyone. Thank you for listening.